All right, so the Fed is in a quiet period or a blackout window, whatever you want to call it. And I think we're going to be in some sort of similar quiet period situation for some time. Now, we've obviously got the Fed meeting tomorrow. It is at consensus that the Fed is going to pause. And for once, for the most part, I happen to agree with the consensus here that the Fed is actually going to finally deliver its pause, that it will view that it could potentially be sufficiently restrictive, although they're not going to want to commit to that. They are going to be watching the price of oil. If the price of oil does make a strong move up, then they will reevaluate that. If some other sort of shock to inflation coming down comes, they will reevaluate that. However, unlike many people in the past that have viewed this pause as some sort of the worst is behind us, that's it. Let's buy, let's send this market to the moon, and let's resume the bull market. I don't think that is going to actually be the correct decision, and I think there is, whether or not the Fed hikes, additional tightening that comes in multiple instances, and I don't think some sort of that's it, let's run it, let's rally this market is something the Fed wants to see either. You've actually seen Barkin talk about how, it's hard to get inflation down when you have so many people that have seen their stock portfolios and their home prices gone up so much, they're not, reluctant to really stop spending. So this is, in my opinion, something they don't want to see. So let's talk about what the new quiet period looks like, why it's actually not just a quiet period, why it's actually a new phase of tightening, and we'll go from there. So the Fed pauses and inflation continues to come down. However, because the Fed has paused and inflation comes down, real interest rates actually go up. This is something that Bostic, who wanted to pause earlier, before previous hikes, was saying. He was saying that it's not that I don't want to do more tightening. I do believe more tightening is warranted. But I think as inflation comes down and we hold, the real rate will continue to go up. None of the Fed members are like these dovish unicorns or anything. So even the most dovish was talking about real interest rates rising as inflation continues to fall. So we are in a new phase, but as inflation comes down, as money feels tighter, as spending drops a little bit, as things come more into balance, that interest rate's going to look a little bit more scary. Having to pay that interest when you're not getting that inflated income, those inflated sales if you're a business, I guess it's income either way, it's gonna feel a little different. It's gonna feel a little different. So we'll see what happens with that. But that is one side of the tightening. The other side of the tightening is financial conditions. Now, it's important to note that credit spends just like printed money. So when you have a lot of credit in the economy, even if you're not printing money, it's very stimulative. It increases spending. The Fed has talked about how if they saw some sort of credit contraction, that maybe that would do some of the work for them. That's what they were saying after SVB. And since then, they have increased rates and increased rate forecasts. However, credit contraction is something they always anticipated to happen, and I don't think they will be shocked if it does happen. So I think not only will real interest rates go up, but credit, which has already begun to contract a little bit, will contract even more as banks continue to get squeezed a little bit. I'm not saying that there's going to be a huge wave of bailouts, but the best way for them to retain capital as these long-term rates have gone up is to not do new loans, as Jamie Dimon said. So I think the new lending is going to contract, and it is contracting right now. That's a good sign for the Fed. It's a good sign for the people who want to get inflation under control. But I think it's going to continue a little bit, and that is going to have some repercussions. So balance sheets of banks are going to be affected, continue to be affected. That is going to affect credibility or lending ability, credit conditions, and tightening financial conditions are typically associated with slower economic growth. However, does this mean I'm in the super bearish, super negative on American business camp? No, that's not necessarily the case. Credit creates cycles. Lower interest rates create cycles. And I simply think we're at a very classical late stage part of the business cycle. I'm not saying that all these companies are going out of business, that the dollar's ending, that this is the end of America, that there's going to be a new world order, even. None of these things. I'm not in that camp. I'm just in the camp that some stocks are very expensive. And for now, I think there are better opportunities in the market. I think there was a lot of exuberance. And let's just put things in perspective. So the average return for the S&P 500 is something like 7% before dividends per year. From February 2020, which was very much a Goldilocks time, we had just gotten a revolutionary trade deal done with China. We had just gotten a revolutionary trade deal done with the U.S., Mexico, and Canada. This was Donald Trump was president. This was a very optimistic and good time for the United States. From then until November 2021, less than 2 years, the QQQ was not up 7%, was not up 14%, but over 70%. Okay? So you had essentially, and I'm saying the QQQ, I get it, it's more volatile than the S&P 500, but many people like to say that the QQQ is the new S&P 500, and newsflash, some of the biggest companies in the QQQ are also the biggest companies in the S&P 500. So it's not that crazy. We're very much a QQQ economy. Those are the biggest earners. So that is, in my opinion, the new stock market index. The S&P 500, also a very good index, but I think they are both very reflective. And I'm just using it as an example. Maybe it's a little hyperbole, but I don't know. I don't have it offhand for the S&P 500. I'm just making my case here the way I'm making it. You can dispute it in the comments. Happy to engage in discussion, of course. Anyways, that's a lot. That is a lot. Obviously, I'm not saying that we got to give it all back or anything like that. Whether or not that is true, I'm not trying to say that. What I'm trying to say is we just had a lot come in. Okay, we had a lot. It's not 7% per year, 7% average. So, pullback is happening. Bounce is probably going to happen for a few days maybe after this pause gets announced. And I don't think we should be too shocked. But here's the kicker. So far, earnings have held up reasonably well. I get Apple, year-on-year declines. No business is going to go up in perpetuity, okay? Nobody should expect that to be the case. I mean, people like looking at quarterly earnings, my opinion, are looking at things too close up. When you're pricing a stock at 20 or 30 times earnings, even 15 times earnings, you're talking 15, 20, 30 years. You're telling me a recession isn't going to occur in the next 15, 20, or 30 years? You know that? Of course you don't know that. Of course you know that there's probably going to be a recession. So you have to understand that if you are owning that business, you are going to experience periods with recession. That's not a lethal situation. You got a fantastic situation before. It's not lethal to have a little bit of the opposite. So, I'm obviously a little bit more tactical than that. I do try to clearly, obviously, avoid recessions. I'm learning plenty of lessons about that. Maybe I should just be a little bit more patient with life and time. But that's what I'm saying. These businesses are fine. Ultimately, they are fine. I'm not saying they're going to collapse. They have phenomenal financial health. That is the state of these businesses. Even if earnings come down a little bit. Yes, the stock prices will come down. That's cool. I expect that a little bit. Particularly in these massive stocks that had such a large gain. I'm telling you that on the video. That's what I think is going to happen. You make your own decision with that information. I went through the Fed. The Russell 2000 is corrected hard. I don't know what's going to happen with that. There might be some slim pickings in there that are good to buy. I own a few stocks in the Russell 2000 and like companies that are small technology bets as very small positions in my portfolio. I don't care if they go down 50%. I think over 10 years, maybe they'll go up more than the average return of the QQQ. I'm playing that kind of time with those positions right now. I think some of them are appropriate to buy. They did start correcting in February 2021. However, do I think the bottom's in? Absolutely not. But if you want to get in a little early instead of trying to find that bottom, some of them might be okay. If they've got some runway, if they've got a few years of runway, something like that, it's okay. And they're a good business. Ultimately, what matters is the product and the business itself. Obviously, you want a good balance sheet. I'm just spitting. I'm just going over everything. And this is where I actually am invested. I actually am confident. Actually am comfortable. Actually am playing for time because, push these stocks down, please. I actually actively want, and Warren Buffett actually actively wants these oil company stocks to be as cheap as possible for as long as possible, because the company can then buy as much stock back at the lowest price possible for as long as possible. That's why you have Devon at almost 10% rig count per share growth year on year as of last quarter's earnings. Anyways, important thing, Buffett buying Oxy above the warrant strike price. So for the past couple years or so, Warren Buffett has been buying Oxy below his strike price on those warrants. He has long-term warrants, essentially long-term call options on Oxy. So in theory, he would only be buying it below the strike price because he plans on exercising the strike price in the future. But if the stock is below that price, it makes sense to just buy it on the open market. Now he's buying it above the strike price. So that means he intends to exercise all the warrants, and he's buying more higher than the warrant price. This is after oil has pulled back a little bit from the highs. We haven't had a new high in oil in a while. Why? Why is he buying it? Because oil could be at $70, and these stocks are still making a lot of money. Still very cheap. That's my take on it. That's what I've seen out of the 9-point analysis on it. I would take a look at that analysis at $70, $80, $90 a barrel, where energy companies rank in terms of free cash flow and PE, forward PE. So it's pretty much a layup to me. That's today's video. That's a check-in. Maybe we'll make another one tomorrow. Until then, peace out. Have a good one.